Hello everyone, welcome to This Week in the Markets. Information contained in this video is intended to be general advice only and should not be relied upon as financial product advice. Furthermore, the advice has been prepared without taking into account your objectives, financial situation, or particular needs. So you should, before acting on the advice, if you choose to act, consider the appropriateness of the advice having regard to your objectives, financial situation, and needs. Welcome to This Week in the Markets. This week we will cover the onset of sequestration, various data releases, movements in the S&P 500 and the Dow, and central bank policies around the world. Sequestration hit the US this week, but the S&P 500 recovered from a low of 1500 to close at 1517 last Friday. In the latest round of budget meetings, House Speaker Mr. John Boehner described very frank meetings yielding no results. Bad luck, mate. The ISM non-manufacturing PMI came in at 56, above the forecast of 55 for February. The sector recorded its 38th consecutive month of growth as 13 non-manufacturing industries reported growth. The long-term upward trend and the fact that it has not dipped below 52 of late further highlights the encouraging sentiment and improving economic conditions. ADP non-farm payrolls also rose by 198,000, beating the forecast of 170,000. January's figure was also revised up to 215,000. Payrolls also has been trending upwards since 2009 and has refused to fall too much in recent years, also suggesting strengthening in economic conditions. The Dow, good old Dow, has managed to hit record highs this week as $10 trillion has been restored to the US equities, fueled largely by the fastest profit growth since the 1990s and monetary stimulus from the Federal Reserve. Retailers, banks, and manufacturers led the recovery from the worst bear market since the 1930s as the Dow took less than 65 months to rise above its previous high set on October 9, 2007, more than a year faster than the recovery from the internet bubble. The S&P 500 also rose to a high of 1543 overnight as all 10 groups in the index registered an increase. Optimism around monetary stimulus underlined by Janet Yellen also may have provided further positive momentum. Thanks, Janet. An interesting point to note is the positive correlation between the S&P 500 and the 10-year Treasury market inflation forecast. The correlation has been relatively less positive in the recent past, but has been really strong up to the end of 2011. Overall, the trend has been quite prevalent for over 4 years now. What this relationship could mean is that investors are yearning for inflation, alluding to David Glassner's The Fisher Effect under Deflationary Expectations research. When this love affair between inflation and stock markets will end is unknown. However, we do know that the conditions that would promote this are likely to be stronger growth, less demand for liquidity, rising interest rates, and strong positive sentiment that these factors will continue. In terms of the US, these conditions will most likely be met when the Fed slowly but surely start exiting from QE, raise interest rates, and consistently positive housing, employment, and manufacturing data drive sentiment. The index itself has broken through the previous high at 1530 and may find positive momentum pushing it higher. Technically, if we apply the Elliott wave theory, we are in the beginning of wave 5, a possible short uptrend. Wave 1, otherwise shown by W1, is the beginning of a bullish trend, and for the index, this was in November 2012 during the US elections. Wave 2 is a small retracement on Wave 1, and this happened in late December. Wave 3, considerably bullish, and in terms of the US, in terms of the S&P 500 itself, where strong earnings provided positive momentum in this period. Wave 4 corrects Wave 3, and this began in late February. This brings us to the beginning of Wave 5, an uptrend. In our charts, the 5-period moving average also crossed over the 14-period exponential moving average, adding further evidence to the bullish trend. In Australia, the Reserve Bank has left interest rates on hold at 3%. The statement released by RBA outlines positive sentiment and expansion from the US, easing of financial burden in Europe, and stabilized growth in China as some of the factors guiding the decision. Domestically, inflation is consistent with the medium-term target as both the headline CPI and underlying measures at around 2.25%. The RBA expects unemployment to edge higher. The ECB is scheduled to release its latest decision on interest rates this week, as Super Mario has consistently highlighted strengthening in the euro area, thus speculating an unchanged interest rate, which would probably be the most logical choice. The Bank of Japan is also scheduled to release a statement on its interest rate decision. Haruhiko Kuroda, nominee for the governor, has pledged to do whatever it takes to combat 15 years of deflation. Good luck, sir. And that brings us to the end of this week's presentation. Let's hope we can all trade our way to the newest release from Lamborghini called the Veneno. On behalf of Trading Pursuits, happy trading. Thank you.